Federal Reserve policymakers also expressed concern about Greece and China and their possible effects on the U.S. economy. At last month's meeting, Hampton Pearson has more on what was discussed and what hints, if any, were given about a potential rate hike.
When Federal Reserve monetary policymakers met in mid-June, they were looking for more signs of a stronger U.S. economy and concerned about the continuing Greek debt crisis, as well as signs of an economic slowdown in China. International and domestic concerns are on the Fed's radar screen and appear to be the keys to the timing of when Janet Yellen and her fellow monetary policymakers will begin raising key short-term interest rates.
Well, I think it's encouraging to see that they were on the ball, that they could recognize that there were risks outside the U.S. that could still present a material threat to the U.S. outlook.
The economy is getting closer to achieving the Fed's dual mandate of full employment and inflation stability, but in mid-June, policymakers judged conditions for a rate hike have not yet been achieved. Many expect labor market slack to be absorbed by the end of the year, and the Fed wants more evidence inflation is moving back towards target levels. And policymakers are still worried about the lingering effects of bad weather earlier this year and the slowdown at West Coast ports on economic growth for the rest of the year.
The committee clearly remained a bit uneasy about the weakness that we saw in the early part of this year, particularly the consumer piece of it, which was more puzzling than the idea that the energy sector was reducing its capex or that exporters were having a harder time because of the strong dollar. The puzzle was in the consumer.
Next week, Fed Chair Janet Yellen reports to Congress on monetary policy and the economy, to be followed at the end of the month by the next FOMC meeting. For Nightly Business Report, I'm Hampton Pearson in Washington.